Oh my God! Look what we did! Look what we did! This is the crossover of the year. I was telling Ian, it's like when the Avengers met the X-Men, and I don't remember when that happened, but I was a comic book kid growing up. But this is so
89.
exciting to me. 89-ish. All right. So for those of you who are returning visitors to the Compound channel, we appreciate you guys coming by. I want to introduce my friends. Start with Ian Dunlap, and Ian does the Market Mondays show with the Earn Your Leisure crew, and we have from the Earn Your Leisure crew Rashad and Troy. So guys, say hi to the folks.
Yeah.
The pound, what's going on?
Thank you for having us. It's an honor.
No doubt.
Pleasure.
And I see all the Red Panda snipers in attendance, which is so
Red
hot.
Panda family.
I'm loving this.
Love you.
This is amazing. So we got a lot of questions from you guys, and I want to turn it over to Ian and just kind of let him moderate and do what he does so well. And some of these questions are just epic questions. Like, we could chop this stuff up for a long time. So let's not spend any more time on intros. You guys know Michael Batnick and Ben Carlson from Animal Spirits, and hopefully you've seen their blogs before, and you might have seen me around. And one thing we all have in common is we're all about learning and passing on the stuff that we learn to other people so they can learn. And it's been a great experience for us. I know it's been a great experience for a lot of you guys in the audience. That's why you're here tonight. So, Ian, let's go to the first thing we want to talk about.
Perfect. Let's take this question from Cody. At what point do Bitcoin doomsday sayers admit that they're wrong? So if it gets to 100,000, will that make it successful? 1 million, what's the number that people that have been down in Bitcoin will give in and say they were wrong about the asset?
So you're coming in hot. We're starting with Bitcoin.
We might as well. Come on. Get the people what they want. GameStop last week, Bitcoin this week.
Ben, you gotta take on when the Bitcoin doomsdayers give in and accept it.
It feels like it's easier than ever to just move the goalposts these days. So they probably just say, I'm not wrong. I'm just early. It's going to zero eventually. I don't know. It seems like people just don't like to admit they're wrong these days.
Yeah, I feel like I thought 50,000 might have been a number. I feel like when it hits 50,000, it's like, all right, that's a legit number, because it seems so far out when it was like trading at 3,500. When it got to 20,000, it was like 50. Can it really do that? And so I'm gonna say 50 is the mark. I think.
Troy, that's like tomorrow.
Yeah. So like the day has come.
I think
It's like one meme away.
I think 100,000, because 50,000 is right here, right around the corner, and there's still a lot of people that have not admitted they were wrong on Bitcoin yet. So I think 100,000. Once it gets to 100,000, that's a benchmark number, and it's going to be very difficult for the Bitcoin bears to.
We agree, though, that there's no like rhyme or reason to what price it is. It's just like, it's a big round number, though.
I'll take the other side of this. Nobody ever relates. The people that have been calling for whatever 10,000 on the Dow have been saying it since 15,000, and we're now at 30, and they're still not giving up. So I don't think these people are ever going to give up. Rubini today was going on and on about how it's a scam, how it's a fraud, how they're shit coins, how there's no intrinsic value. So I don't think it's a number where at 100,000 they're going to be like, all right, I was wrong. That's not going to happen. I think the only thing where they can genuinely say, okay, you know what? I guess I was wrong, is if there starts to be like more activity on the blockchain, more like actual use cases besides for just the price. On the price alone, it could go to 250,000. But if there's no like use case that they can see, they're not going to give up.
This morning, Bank of America, New York Mellon, like the most conservative financial institution in the country, has its roots with like Alexander Hamilton, right? They came out and said they're going to start they're going to start providing custody. They're going to start like, if you needed an off ramp from being a bear, if you ever needed an announcement to be like, all right, now it's legit. Like, I feel like you had it today. So I hope you took it.
There you go. That's what I said. The day is here. 50,000.
I feel like Bitcoin is one of the most obvious plays that we've seen in recent history. It's like when you see all these banks, when you see Elon Musk announce that Tesla buys 1.5 billion, when you see Cash App, they're not making these adoptions and actually adding Bitcoin for their platform because it's not going to work. It's obvious that it's going to work.
But without 0% interest rates and without the crash, do we think the price would have been as high?
I don't
think so.
I think so much stuff that's worked out really well in the last year, like it's all one trade. It's all this big bet on. I don't care about current cash flows anymore. I only care about capital appreciation because there are no yields anywhere. And I think a pull up in rates, it'd be interesting. We don't really know, right?
Yeah.
So we've never had a rate hike cycle with Bitcoin this widely traded. So we really there's no chart you can go back to and be like, oh, this is what happens when rates go up with it doesn't really exist yet.
Well,
Yeah.
I don't think anybody who owns Bitcoin is gonna be like, oh, now the 10 years at 2%. Let me take my money out of Bitcoin. But
That's true.
But the way that I think it's wrapped together, I think a lot of early Bitcoin money are Silicon Valley guys that have been huge beneficiaries of low interest rates. And I think that they were the early money. They were the big money that was pushing this around and staying there. So I think it's all one trade, even if it's not people judging Bitcoin versus interest rates.
I think there's a whole generation though too, and I think you guys at Earn Your Leisure reach a lot of this generation where they didn't even start with stocks.
Yeah.
They started with crypto, and that's like a whole stocks are almost like I'll get into that eventually, but I'm making so much money doing this.
Every day,
Yeah,
we just did a talk with Facebook, the employees at Facebook, an hour ago, and the first question was crypto.
Yeah.
And every day somebody asks me about crypto. How do they get invested? And I asked them what are they currently invested in? They said nothing. And I'm like, I don't think it's pretty a wise decision to just jump into crypto before you do stocks. And they're like, I think it is a wise decision.
Yeah, it's like, stocks have become like what your grandpa does.
It's a hot take, but Ben, do you think Bitcoin will be the Dow 30 for this generation?
I do think like the fact that these people came up with this, they've like think about how many crashes we've lived through in the last 20 years. So anytime you came into the market in the last 20 years, it could have been a year ago, it could have been 5 years ago, 10. You've lived through something. So you had the .com crash, you had the 2008 crash, the housing bubble. Now you had last year with the pandemic, the corona crash. You know what volatility is. So I feel like it might not hurt them as much anymore. And people dove in with both fists in March, which was crazy, which you don't really see typically.
Oh, you think they're less sensitive to market swings because it's all they know?
I think things move so much faster. I've been putting this out for a while that I think like anytime there's a downturn, there's so much money floating around and just with nowhere to go, people are going to hop in. Anything that falls.
Let me ask you guys this, because we are in crypto, but we were in crypto in 2017, and we witnessed that tremendous fall. It was catastrophic. A lot of people lost a lot of money, including us.
Yes.
So if you study Bitcoin's charts, you know that's really commonplace. It always has crashes. So when this crashes, because it's going to crash, and then it'll go back up again. How do you think the reaction is going to be this time around for retail investors that are investing now at 45,000? If it gets to 15,000, like, do you think people will like lose their mind and jump off the Bitcoin coin altogether, or are they still going to be enthusiastic about it the way they are now?
I've never seen a religion be bigger.
Yeah. So I almost feel like this is like asking when people are going to abandon Trump. Like his 40% of the country, like it's never going to happen, no matter what he does. Like I don't mean to equate like Bitcoin with Trumpism, but I'm just saying like there are just certain things that people just will never jump off of, and this is starting to feel that way, even though it's only really been 10 years. Like I'm just starting to get that sense. In 17, I think the thing that put the top into Bitcoin probably couldn't happen again. So I don't know what will crash it. I agree with you, though. It's like part of the game. Yeah. But the thing that put the top in, and literally to the day Bitcoin topped was the day Chicago options started trading. So you didn't have a two-way market in Bitcoin until that moment. There was no way to short a Bitcoin. You couldn't borrow it to short it. Once they started trading bullish and bearish options, all of a sudden a two-way market was enabled. And I'm not saying short sellers pushed it down, but there was all of a sudden a way to bet against it that didn't exist the day before. That couldn't happen twice because now Bitcoin futures are already very widely traded. So I don't know what will be the next thing.
Do you think we can see that in Ethereum? I mean, that just started trading this week, the futures. You think?
I didn't know that.
Yeah,
okay.
That opened actually on Monday. So if that's true, then somebody could actually start shorting Ethereum now that it's all-time high.
I mean, people wanted to like. The crazy thing is that retail is in this so early. I mean, couldn't you say so much of this institutional money that's coming in now that this has anticipated it? Like, what if this is a sell in the news thing where all these huge price gains, it's not just Elon Musk memes that people are buying for. It's because they knew this institutional capital was coming. Are they going to be the bag holders for the next crash? Potentially?
I think institutional money is coming, but it hasn't fully come in yet. And then right behind it is wealth management money. And wealth management money is very, very big. It's like
sticky.
$30 trillion. So I don't know how you figure out how much will eventually come in. But, I mean, I think if there wasn't Bitcoin, gold would be 3,000 right now.
I agree.
Yep.
You agree with that? Like, I really think that.
Two things. One, as we're talking, Bitcoin's about to hit 49,000. So it dipped a little
50,000
bit.
I hope. Yeah.
Hold on one sec.
Yeah, exactly. It dipped a little bit. But you asked the question, like, when are people going to panic? At what point? Is it a 50% crash, 60% crash? The only way we get a crash is because people are panic selling. You don't have a crash and then people start to sell. You get a crash because people are selling. So it's sort of like this circular loop that it's hard to answer. Like, when is that point where people for the exits? Because by definition, that's when the crash happens.
Yeah, but then the whales manipulate this thing too, because we really study this whole crypto space, and that's what happened. It might be a little difficult now because there's more money involved and more institutions, but the whales really manipulated this thing in 2017. That's really my opinion, because if you really do the research on it, no, they never lost any money. Majority of the whales never lost any money when Bitcoin went down. They sold their Bitcoin. They got in altcoins. They waited for it to go down, and then they just piled back in Bitcoin.
And it was the same thing like what we're watching in the meme stocks now, where we see some of these things just run up, and then in 2 days they're down. We were watching that happen literally almost every 5 hours in the crypto space. It would be like pump and dump, and before you knew it was one that went to 12,000%. You're like, damn, I missed it. And so now you're like obsessively watching to see which one is the next one. And the whale's just like, all right, pump, dump, take money.
What do they do when the whales get out? Do they go into like stable coins or tether? Like what's the mechanism?
They're rotated to some of the smaller ones. But I think Bitcoin may be the greatest example. If you hold for a 5 or 10 year period with any asset class that's going up, I think you'll have some safety instead of jumping around to Doge or whatever other shitcoin is out there.
Doge.
You guys get questions about Doge?
Doge.
Oh, yeah.
We won't bring those up.
Of course. Who do you guys think would be the next mega cap company to invest in the space? Like we already saw PayPal. We saw Tesla just come in.
Apple.
I
think Twitter.
The Fed?
Jack loves it.
Well, Coinbase is going to do a direct listing IPO probably in the first half of this year. And supposedly that could be a $75 billion valuation out of the gates.
Wow.
It was 50 2 days ago.
So Schwab is worth $100 billion. So the idea that Coinbase could be the same size roughly as the largest brokerage firm in America, and Schwab, by the way, I think 4 or 5 trillion under management. That's just like mind-boggling to me. But if you told me, hey, Coinbase came public this morning, it's worth $75 billion, like I don't even think I'd be shocked.
Yeah, you in trouble.
But let me ask you this: at some point, is Bitcoin ever going to have like a real purpose? Because it's like for the majority, you can't use it. You can use it at some places, but you really can't use it. But I feel like people is just buying it to hold it. Even gold on a certain level has a point. Like you could have a gold watch. Like what is Bitcoin's ultimate use case?
Yeah,
buy pizza.
Well, what do you think? What do you think?
I don't know, because I feel like cryptocurrency, the currency part is extremely misleading, because it can never really be a currency. Currencies don't move like that. It can't be 49,000 one day, 53,000. You
wouldn't accept it.
Yeah. Honestly, the best use case is like people outside of our country that need to move it and get out of there. It is because Michael and I read a paper last month that said like someone moved like 1.5 billion in Bitcoin and it costs like $10 and it happened in 10 seconds basically.
Yeah.
So I think like
from where
I don't know, they can track this stuff, but I think the whole millennial gold thing is a good story. But like I think for these emerging market people that want to move and hide it from their government or something and get it out of the country to families or something, I think that's actually a good use case story and maybe even a valuable commodity for it.
So to me, that's the story where the Bank of China, the ECB in Europe, and the Fed come out with their own digital currencies. And those, I think, could compete for dollars or for euros or for yuan with Bitcoin. And the reason why the governments are all experimenting with their own digital versions of their currency is because they want to have that surveillance back. They don't like the idea of not being able to track what people are spending on.
And that's why they had so many privacy coins, right? It's because it was like, yo, you can't track where the money's going. And so if it gets in the wrong hands, which it did allegedly, it was getting into like you've seen like the Taliban had
North
Monero.
Korea.
It was like, this is crazy. Like there's no way to track this money. They're moving 48 million and nobody knows where it came from and where's it going. So it becomes like a dangerous thing in that sense.
Yeah, let's talk about hedging real quick. Sebastian has a question. Some hedging strategies I've talked about, including shorting the index, buying puts, trading the inverse indexes. What do you think is the safest strategy to protect yourself against a crash? And do you think we're going to have a crash coming in the next year or so? Because everyone is worried like crazy. I always say not to worry about it, but what do you guys think? Duncan, is question number one.
So like just different ways to hedge against the risk you're taking in a portfolio.
Yeah, what would be the best way? And then do you think a crash is coming in the next year or so, or the next 2 years?
Well, we have the numbers. Historically speaking, let's define crash. I think a crash is 35% or worse. I think we think in terms of like a bear market is 20%, but a crash is really rare. I think there have been 12 of them going back to 1926. So for as long as we have good stock market data, there's been roughly 1.2 crashes every decade. The big problem with timing them is that they don't show up on a schedule. So you had like a bunch of them in the 1930s. You had a big one in the middle of the 1970s. We had two in the last 20 years, 2000 and 2008. But then look at the 1980s, none. Like the crash of 87 actually only got down to what, Mike, 23% at its worst?
I think it was 30.
Did it get down to 30? But intraday. Yeah, it didn't stay there.
We just had 35 last year.
At 35 last year. There were no crashes in the 50s.
None.
There were no crashes in the 1960s. Yeah. So in other words, you could go two consecutive decades without a stock market crash, and then the next decade you could have two of them.
Yeah, but I think there's so many maniacs out there these days. They're not going to let us off the hook. Like I feel like these bubbles are going to come way faster than they ever did in the past. Like technology has sped this stuff up, I think. But hedging and stuff, like if you're trying to short the indexes and buy puts, your timing has to be perfect on those if you're gonna do it right. So like the easiest hedge for anything for market wise is just hold cash, hold more cash. That's the easiest one, right?
When you say that, you're the least popular person at hedge fund.
Everyone wants to
hedge fund
risk
camp.
Stuff. Everyone wants
I know.
risk stuff. Guess what? Just hold more cash, because if you short stuff now and it goes against you and we do get in this massive bubble, you're going to be punching yourself in the face because it's going to go against you.
Whose quote was it? I think it's maybe Peter Lynch, that more money has been lost anticipating corrections than in the corrections themselves. Yeah. Right? Mike, is that Peter Lynch?
I think that's Siegel, but I'm not positive. It's one of the two of them.
Beanie Siegel?
Beanie Siegel. Of course, yeah.
Beanie Siegel?
I mean, go ahead.
I think the best hedge too. I mean, this might sound boring and not what people want to hear. We can talk about inverted indexes and all that stuff, but the best hedge is to buy good companies, good ETFs for a long period of time and just hold them.
Yeah.
I mean, even options, we do long-term options, so it's like it's a lot less risk. You buy long-term options as a short-term option. So I personally think the best way to hedge risk is to buy good companies, good ETFs, and hold them for as long as you possibly can.
Yeah. Have you guys ever seen anyone lose money holding for a 10-year period in quality?
Right. Well, if you look at history, you have an 88% chance of being up in the S&P 500 if you hold for 10 years, starting any month of any year over the last century. All you had to do was hold 10. If you extend that out to 20 years, you historically have a 0% chance of being negative over 20. Now, not all 10-year periods are built equally. Some are way more gut-wrenching than others, and that's where we get into like the map is not the terrain. So you could give somebody the map. You could say, look, these are the numbers. This is what happens when you're a long-term hold quality stocks. But then the terrain is what you actually have to live through and get over. And that is not quite the same as just looking at lines. which is, I guess, why I have a job, right?
Yeah.
As a
Yeah.
financial advisor.
Josh, Mike, Ben, Rashad. So with that data, knowing that people will win with that high of a rate, how do you get people to stay in the market and not deviate from the plan when we have a 10% drop or 15% drop and some idiot on a message board tells them they should get out? Like how do we mitigate that risk?
Well, there's two things. One, getting back to like hedging risk. This is corny, but I think it's true. The best way to hedge risk is just to understand that risk is the source of all returns. And if you want to eliminate risk, you're going to dampen your returns. There's just no two ways about it. You're not going to sell at the top and buy at the bottom. That's fantasy land. So get over it. And the best way to protect yourself against people telling you the world's going to end is you got to filter properly. I know there's a lot of noise out there, but you have to resist the seduction of listening to bears that are going to call the end of the world. Those people are just they're toxic, frankly, and they're going to be right once or twice. You have to tune them out. You have to.
It sells a lot of books, though.
Hell yeah.
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 One
just
good
started
method is lose your. Oh, sorry, my bad. One good method is to lose your password to the brokerage account.
That helps.
Want to throw that out.
No, I was saying that for like in the past 2 months, I really started studying the inverse indexes. And so I just started treating that like insurance. I was like, all right, I'll allocate a small piece. I know it's going against the gains, but I was like, all right, I'll use this as insurance. And every 6 months, I'll put a call on it, right? And I'll say, all right, well, I'll put a call on something like a SDAO, and I'll use maybe 2,000 to 3,000. I'll say, all right, if I lose that 3,000, okay, but that means I've made so many gains on the other side. So I'm like, all right, that's gonna be my insurance. I paid for my phone. I have insurance. I have life insurance, and now I got insurance on my portfolio.
I've always thought of it that way. Like whether you're holding more cash or you're doing something with an inverse index or you're selling calls against stocks that you want to stay in, like whatever you're doing, just like as long as you go into it knowing this is a cost, not a profit center. Like my hedge is my insurance cost. It's no different. And then if that's what you do, don't throw them out. Just because the market goes on a huge run, don't stop paying insurance because arguably that's the moment where you need it more than ever.
Right.
Yeah.
Steve has an amazing question. Oh, Rashad, go ahead.
No, I was saying I think that you know how when you get a job and you have to do like a personality test, and it's like if somebody cuts you off in traffic, are you gonna like bash their windows in? If you do that, you're probably not good to be a kindergarten teacher. So it's like I feel like they should have like personality tests for investors because it also depends on your personality. That's not talked about either. There has to have like a whole psychology behind investing. Everybody's different. Like me personally, I have a high level of anxiety, so I don't take risk. I'm very conservative with my portfolio, and I know that if my portfolio doesn't work out, everybody's going down. So
taking us all with them.
Well, I love it because
such a great point.
You could have a perfect investment strategy, but if you can't stick with it, it's no good to you, right? That's perfectly said. I like that.
Steve has a great question.
Go ahead, Ian.
No, sorry about that. Do you guys lean more towards technical or fundamental analysis? And can you walk through why you lean towards one particular direction? I think this is important because there's a battle of one versus the other. And I think it's both, but I'd love to get your take on it.
We're both. Michael's our director of research at the firm and very deeply involved in all of the strategies that we've built. So I think Mike should take this one from our side.
All right, Ian, you're right. I think you could use the best of both worlds. One is not better than the other, but you have to define your time frame. If you are a short-term trader, I don't know what fundamentals you could possibly be looking at that will determine the price over the next week. Right?
Momentum, that's it.
Right.
Yeah.
So if you're a trader and you're looking at economic data, good luck to you. You know, that is the hardest game in the world. You're competing against the Stanley Druckenmillers of the world when you're doing that. So if you're short term, I don't know what you use other than technicals. If you're longer term, I think it makes sense to pay attention to the fundamentals to make sure that the company is going in the right direction. So I think it just depends on whether you're short term or long term. And then if you're intermediate or whatever, you could blend the two. You could look for companies that are growing their earnings and make sure that their stock price is not crashing. So I think you could use both.
And I'll say this: technical indicators are nothing but a representation visually of the fundamentals on a chart.
Correct.
That's it right there.
That's it.
Like,
So it's not some gang war between the two. Like
it's
use
even
both.
bigger than that. That's like the basic element is like you're not really investing in the company in the short term. You're investing in other people's perception of the company.
Yes.
Right? Because the fundamentals aren't changing as quickly as people's opinions change. That shit could change overnight. It's very rare, other than like a drug company that gets an FDA approval or something. It's very rare that a company's fundamentals change in one trading day. So you're right. Like you're looking at technicals and you see a stock. I was looking at PayPal the other day. I'm in PayPal.
Me too.
And it's almost like a backdoor Bitcoin play, sort of.
Yeah.
But obviously payments and Venmo. You look at a chart of that. It's compounding since it spun off of eBay. So 5 years we have data, right? In the last 5 years, it's compounding at 40% a year, which is 4x the S&P 500. But that's not happening in a vacuum. That's the fundamentals, because this company now has almost 400 million users, and they didn't have that in 2015. I don't even know if people were Venmoing in 15. Maybe not.
I don't think so.
So it's like the chart is the fundamentals over a decent enough period of time. I feel like
Always.
they're not
Almost
separate.
Almost always. If you look at any financial metrics of PayPal, revenue, I mean, whatever. I'm just pulling up revenue. Revenue went from 8 billion in 2015 to 21 billion.
Yeah.
So, I mean, stocks don't go up or down by accident. There's no amount of buying that can keep a shitty company down, and there's no amount of selling that could keep a good company
other way
down.
around.
Other way around. You know what I'm trying to say.
Yeah.
So stocks usually follow the businesses over long periods of time.
Stocks can go up by accident, as we learned 2 weeks ago, but they can't. But they can't. They got to stay up on purpose.
Yeah.
I don't know, Ben. You got a take on this?
Well, I think this gets back to your personality thing too. Some people are just never going to get the whole momentum trading technical thing, but you can't beat your head against the wall then if you say that fundamentals are detached from reality, or whatever, because that always happens in the short to intermediate term. So part of it is setting the right expectations. If you're going to be a fundamental investor, you probably have to wait a lot longer to see something work for you or happen. Whereas if you're a short-term technical momentum trader, you're going to get those signals and you're going to know whether you're right or wrong much quicker, probably.
Yeah, and I've always stated that the best technical indicator is time. 10 years, 20. No one wants to hear it, but it's the truth. Cliff has an amazing question for you, Josh. You stated that you don't have price targets for sales. He was running out of patience on JP Morgan. He wants to talk to you about opportunity costs and how to know when to sell and why you don't have particular targets on the positions.
Yeah. So JP Morgan is a stock I've been long for years, and it's a really good case in point about patience, because that stock sat flat for 3 years. It had like a range. I feel like the range was maybe 90 to 120 back and forth like ping pong, and the dividend's not huge. It's probably a 2.5 or 3% yield. So you're sitting there, and you're watching PayPal double and then triple, and you're watching every other financial technology stock do so well, and then all of a sudden JP Morgan explodes from like 100 to 140, and it happened in like 3 weeks. And one of the hardest parts about being a buy and hold investor, I want to hear from Rashad on this too, but one of the hardest parts about buying quality companies and sitting on them is that they're streaky. They don't always have a chart like PayPal where they're grinding higher for years and years and rewarding you every month. A lot of times you just have to sit there, and then you sell, and then you blink your eyes, and all of a sudden it made the big move that you always thought it could make. Not every stock rewards you with a gradual uptrend. A lot of them, they just pop, and who the hell knows when that's going to start? You feel
But
that
you know,
way?
in banking is going to be slower. You know that.
Yeah.
Yeah, I feel like that's something we were going through.
That's why I like ETFs, because I don't. You can't trust the stock. It's like a player, like in the NBA. Like you put too much faith in one player, and then he has a bad 3 months, and it's like your fantasy team is crashed. So I prefer more ETFs because it's like, all right, yeah, I trust Apple, but Apple can move sideways. Like AMD, I've been watching AMD move sideways since September. It's like it's not doing anything.
Yeah.
My SMH is going through the roof right now.
So I was telling Michael this today. I wanted to bet on the online sports gambling stuff, but
This
I did
kid's
not.
like a junkie gambler overnight. Right?
Why
Yeah.
not? Why not?
But
They've
I
tainted you, man.
I didn't want to pick a certain stock though, so I picked an ETF that just invested in a basket of them. And the way that you can play themes like that these days, for me, maybe I'm a little wimpy because of this, but I think that's an easier way to play it, where you spread your bets and you're going to get a little bit of the biggest winner, but you're not going to try to have to pick through and potentially get the biggest loser.
That's the downside, though. If you buy, let's say you're like, I'm bullish on cars, and I want some electric vehicle exposure. And I don't even know if this exists. You buy an ETF of automakers, and then Tesla is 5% of that ETF, and then Tesla goes on to rise by 800%, and you're like, shit, I should have owned more of that. Yeah. But I'm allocated to Toyota. So
I did both. Tough. So what he's saying, that's true. So that's why I did both. So like we had SMH. I'm like, great. What's the highest allocation SMH? TSM. All right. Well, I'm gonna get a single position in TSM, and I'm gonna get SMH. But back to what Ben said, I did the same thing, but I had to learn. So I was exposed because I had DraftKings as an individual position, and I was like, all right. I learned my lesson from that. It crashed, and I had a call on it, and I was like, all right. Well, how am I gonna learn from it? All right, I'm gonna go longer term on my DraftKings, but I'm also gonna find an ETF that has all those gambling sites in it. You know what I mean? So like, I'm looking for like, where's Flutter at? Where's Penn Gaming at? Where's Draft? They're all in the same thing. All right, let me invest in that too.
Or sometimes like when you just don't know. Like we was in Miami, we got stranded in Miami last week, and because of the snowstorm, we couldn't come back to New York. So I was in my room, and I had some free time on my hand, and I was just thinking. And my son is like a huge video gamer. And he's addicted to video games, on the YouTube channel and everything. And I realized how big this whole video game movement is. So I know there's the ETF Hero. So I'm like, all right, I look in the Hero, I see all of these Take-Two Interactive and Activision, Nintendo. I don't really know enough about any of these companies to feel 100% confident. But I'm like, in my gut,
chances are,
in my gut, I feel good about this situation. I put a call on it for August, and I'm up 40% in 10 days.
Yeah. Ben, did you get in? Are you in bets? Because he did Hero, I did bets, and we're both at 40. I'm like, I should have thought that.
Yeah, I did the bets one too.
So I say that to say I feel confident in that situation. I would never feel confident putting that type of situation on an individual stock because I know the industry. I don't know every individual stock, but I know the industry, and I understand that it's a recession proof. It's only going up. And I have a vibe for it because
you're invested in it.
I'm seeing it, and I understand like FaZe Clan. There's a whole movement. If you might not know about it if you're over like 25 years old, but if you're a teenager, you see it's this snowball is turned into an avalanche, and this video game thing isn't going anywhere.
It's your whole social life. Yeah. My son and all his friends, that's how they talk to each other in the game.
Yeah,
that's like FaceTime. That's like FaceTime for them.
Absolutely.
So one thing that's really great about this moment in time, if you use it right, there is a thematic ETF for anything that you could think of. And when I started in the business in the late 90s, if you were like, I'm bullish on video games, I want to get long, you had to buy a basket of each stock individually. There was just no one ticker symbol to get long any of these ideas. And now there's like two for every theme. Mm-hmm. So, it's definitely given you a way to very easily make a bet on an idea rather than just pick one company and hope for the best.
Yeah. Speaking of themes, Nima asked a question. I have no exposure to hotel or resort reopen stocks. Which ones would you recommend? The ones he has his mind on is Caesars, MGM, and Wynn. Mike, Ben, Josh, Troy, Rashad. What do you think about the hotel reopen stocks?
Well, you know what? I'm always looking future forward. So my favorite hotel stock is Airbnb. If you're looking at 15, 20 years down the line, Airbnb's here to stay. It's unstoppable. It's like Bitcoin. Bitcoin's unstoppable. Airbnb was faced with the most tragic, traumatic thing that could ever happen to an industry with Corona. It withstood it, and it's still standing.
An IPO.
I fully believe in Airbnb. Once again, one of these things where I travel, I use Airbnbs. I know a lot of Airbnb hosts. They've had issues. They still have problems, but I believe in the company. And I think
you guys ever get Chesky on the show? You guys ever try to get him?
Not yet.
Not yet.
Do you know the story of how he kept Airbnb alive in the financial crisis when he founded it?
Yeah,
the cereal box?
We did an episode on that. The cereal box situation?
Yeah, it was
crazy.
Yeah.
Legendary
story.
My travel stock my hotel stock is not a hotel stock. I think Expedia. I don't know, Duncan. You want to pull up a Y chart on this thing? EXPE. So this thing is on the verge of a massive breakout. If you go back to July of 2017, it was 159. It has since been cut in more than half. The low from the worst of Corona was like 43. It's come all the way back to 147. It is now trading above the fall of 2019 when there was no Corona. Now, people look at that and they're like, well, the whole opportunity's gone. It's back to where it was before the pandemic. No, here's what you don't understand. Like many other companies, Expedia used the crisis. They used it. They got even more financially fit. They were able to refinance all debt, raise money, raise equity capital. Like, this is a way to bet on the return of travel without, like, it's what you call asset light. Like, you don't have, they don't own anything. They don't own airplanes, but you know they're going to benefit when people start booking flights again. They don't own hotels, but you know they're going to benefit from people booking hotels again. So maybe some of the recovery is already priced in, but on a technical level, I think if it can get through 150, there's
And break an all-time high. Yeah.
I don't think there's any sellers left. If you were going to sell it, wouldn't you have sold it already?
Yeah, you would have sold it already and took profit probably December.
I think Expedia is a great indicator, right? So rather than looking at the hotel stock or the airlines, look at them, right?
Yeah.
They're going to tell you if people are traveling. So if you want to get into those industries, it's like, all right, let's see what Expedia is moving. Okay, let's go find a hotel stock because they're going to go coincide with each other. This is the platform that gives you the hotel package with the airplane.
Let me throw one more in. Same exact idea as that, Troy. BKNG. It's not Burger King. It's Booking.com. It has the same chart as Expedia. So you can see that same thing where it's just now gotten back above the pre-pandemic. Pull that back, Duncan. Go to 5-year.
Yeah. Oh, yeah. Go to 5-year max, Duncan, real quick.
So you can see this thing is like poised, right, to make that move. And I think this is hotels.com and a whole bunch of other brands all bundled up into one. But anyway, I think these two stocks, if you don't want the risk of owning airplanes, is an interesting thing to look at.
You know what the pattern is too? I've been noticing too, and you kind of said it, Josh, is that you're starting to see a lot of these companies, they're going back to their February 2020 mark, right?
Yeah.
And so if you look at Expedia, I know right here, but another one of our favorites, Live Nation, right?
I'm in Live Nation.
I know. I heard you say it. I'm like, oh my gosh. I've been watching it since March, obviously, because I'm like, wait, I'm a constant goal. This is dead, but it was
LYV.
It was gonna hit its all-time high. It was trending like ridiculously, and then Corona happened, and now it's right back where it ended in about March.
Yeah. What shows you guys trying to go to when we're allowed?
Crazy. I saw Usher's going to be in Vegas, so in the summer he has actually tickets on sale right now.
I'm gonna be honest.
That goes crazy.
I'm not bullish on Live Nation.
Why?
I don't believe that the world is ever going to fully get back to how it was. I think that these virtual experiences are going to be the new wave. Yeah. And I watched a couple virtual concerts, and they're actually pretty good. And I don't know. I'm just not 100% confident, especially when we got to start talking about virtual reality and augmented reality too. So when these virtual reality platforms and augmented reality platforms really come into existence, it's like, do I really want to spend $300 to sit in the nosebleed to watch Beyonce when I could spend $100 and feel like she's right in front of me singing? I just feel like Corona is not something that's just going to go away. And also, even if it does, the effects of it is going to change the world. And one of these things, I don't know if we're ever going to get back to the full experience.
If they do all the shows in Atlanta, Houston, and Florida.
But they're also starting to package the technology. So like they're looking at it like that, right? So the person who used to go to the show, you could still go, but now they're having the technology, whereas like you could have the show from your house, right? So you're talking about the virtual concert. It's like, they're creating the technology that goes around the stage, and it's like, instead of paying $300 for a ticket, I'll pay $9.99 to watch this concert from my house. And so
what if Live Nation though is the company selling that?
Yeah,
like, you see what I'm saying?
They're planning to, when Beyonce does something big or whatever, they're planning to make it so that, all right, you're not coming to the show. Here's a way that you can watch it from where you are, and they have the rights to that show because it's at their venue.
Exactly.
And maybe they're streaming it, and they become a streaming business.
Here's a place though that is guaranteed to be sold out for years after the pandemic, because I have little kids. Disney. That is
Absolutely.
that's your barometer. Disney is gonna, and you have the streaming to hold you until then, right?
Absolutely.
Your kids been to Disney, Ben?
Yeah, and I mean, my wife's already planning our next one for 2022 or whatever. Like right now, she's trying
You're
to get
paying
in.
you're paying the Disney tax twice. I only paid
Yes.
that shit once.
Disney.
I mean,
They could raise the prices by 100%, and you know
And
that
people will
would
still
pay
go.
it.
they're gonna
Yeah.
go. Yeah. Wait, they had their earnings today. I didn't even get to see how to do.
They
it.
did. They're up a couple percent after. I think they did okay after the close. But
Well,
that's
90
one that is.
Can you use Bitcoin at a Disney within the next 3 years?
3 years and probably more likely. Yeah.
That's the barometer.
There's a whole bunch of misinformation online about institutional levels, and you can buy stuff for $9. And like, is there a way that retail traders can track what the market makers are doing in real time, or is all of that just bullshit?
Mike, what do you think about
Tell
that?
the truth, please.
You've been writing. You wrote a really good thing about Citadel and the market makers and what you believe and don't believe is going on. What's your take?
I think it's a distraction. I mean, if you're worried about fractions of a penny that you're not getting best execution, I mean, you're not a high frequency trader. Don't play that game. Don't worry about it. It's a total distraction. And we've been talking a lot about individual stocks, and I love it. It's a lot of fun. But I think that stocks are like the toppings, and I think that you need to have a solid foundation. And sorry to be so boring, but you got to eat your index funds. And I think that all of these
Cut this kid's mic.
all of these individual stocks should be like complementary to just getting market returns.
Nah,
Everybody agrees on some level of that. I think
That's not true at all.
That's not true at all.
Yeah, it's a new generation. Like in the last 2 years, who don't want. Anytime I bring up indexes, they're like, "Get the fuck out of here!" Like,
I'm probably getting dunked on right now. I probably sound like a dinosaur.
they're killing you on YouTube. No.
Yeah, yeah, a lot of people's not really agreeing with that philosophy anymore, because it's like, especially with the rise of option trading. Gotta talk about that. Like, this is
but people aren't reporting their losses either. Everyone's like, "Yo, I'm up 1,000% on $200," but when they blow their account and margin call, there are no Instagram posts on that.
Yeah,
None.
yeah, those go to right to Reddit. Those not for the gram.
Like, I'm with you 100%. So like 6 or 7 months ago, I was like, "Yo, this is too much," and so that was my philosophy. It was like, I'm going to create a table, and so my table has 4 legs. I'm going to create 4 strong legs for my table, and so those were ETFs. Somebody might say those could be indexes, and anything else like these singular plays, AMD or Apple or Tesla, those go on top of my table. But if I don't have a table to stand on, I can't get those things yet. Like, let me get my base, and then I'll build on top of it.
I'm the same as you, Troy. That's what I've always allocated. We have an automated online advisory service we built with Betterment. It's called Liftoff, and that's where like every month my excess cash that I'm investing, it goes right into that alongside all the clients, and that's like my real money. But then I want to own names. Like, I want to own Live Nation.
By the way,
it's tiny in the index.
I did the same thing, but I'm just saying, if you're trying to get rich overnight, that's like being me. I haven't lifted a weight in my entire life. If I just start taking HGH and lifting, if I start taking HGH and lifting, I'm gonna fucking die. So it's the same thing with stocks. If you just start going crazy with options and you have no foundation, you're gonna blow yourself up.
Get rich or die trying.
You're gonna die. You're gonna die. You're not 50 Cent.
We haven't had money for so long, and like the first time we can like, yo, that's the fastest way to get it. It's like, all right, I'm going after it full throttle, and it's like in 2 weeks you'll be back to where you were.
But
before.
you know what? Sometimes you win.
Yes, you do.
That's the dangerous part. That's the dangerous part.
That's the worst thing that can happen.
It's like, yo, I gotta keep this hot streak going. I can do this. It's like,
and I think there are a lot of people that have it. It's like completely separated, where they have their 401k or their IRA or whatever, and they're automating into that, and then they have their Robinhood account, and they're trying to blow themselves up.
If you date the head of the cheerleaders in high school, and then the rest of your life, like you don't match up. So I think about a kid that started investing in like May of this year, and like made 180% in 8 months. You may go the rest of your adult life and never have a run like that again.
Yep.
Like you might have. I mean, I hate saying this shit because I don't want to be discouraging, but like one should not expect 50-60% returns every quarter as though like it's normal. It's not. This is not a normal environment, and I don't think we've ever seen anything like it before, and may never again. I hope it doesn't end tomorrow, but I'm just saying it ain't going to be this way
Please
forever.
Don't say that, Josh.
No, you're absolutely right. Michael's absolutely right. You know, you gotta be responsible. And once again, it goes back to knowledge and learning your risk tolerance and things of that nature. But index, I kind of feel like S&P 500 index might be a little bit outdated because I feel like it's kind of too broad range, and that earning 7% doesn't really sit right with my spirit.
NASDAQ is better.
ETFs. I like ETFs. I feel like if you have 5 or 6 ETFs, that's a nice broad range diversification of the stock market. I'm not really feeling the S&P 500 play too much.
If you have 5 ETFs, you probably own like thousands of stocks.
Stocks, it's too much.
Not really, because like if you look at XLK, it's like 30 stocks. SMH, I think it's like 20
sectors.
Yeah, so that's what I'm saying. So it's like, you know, you have like SMH, XLK, QQQ, XLY.
Mm-hmm.
Call it a day.
That's his table.
should everyone focus on expense ratios or when looking at ETFs, or should they look at the management? Like if Kathy's managing it, a higher expense ratio is fine in comparison.
Imagine you were about to buy ARK and then you didn't because the expense ratio is too high.
You're a fucking idiot. Yeah.
It's like what, what did they say? Picking up nickels in front of a steamroller or something, or stepping over dollars to pick up nickels or something.
Yeah.
Right. I think costs really matter, and controlling your costs is one of the keys to long-term performance. But if there's a part of your portfolio where you're really looking for alpha and you want to hire a great manager and you feel like you've done the due diligence and you found that person, like whether or not they're charging 1% versus 50 basis points should not be the yes or no factor for that portion of your portfolio.
Personally, why do you guys think there haven't been more women? This is the first time I've ever seen a woman paraded as a great investor. Is there any inside information that you guys have of why there aren't more? Because it's not like the talent isn't there. There's some probably at every organization, but I feel like Kathy's the only rock star that's been mentioned in the last 60 years when it comes to investing.
There's been studies done, and it's just common sense when you think about it, that women tend to be better investors than men primarily because they're less emotional.
Yes.
Right. Like we try and beat our chest and try and hit home runs we tend to be overconfident. So there absolutely should be way more women portfolio managers than there are.
One of the things that gets lost with Cathie Woods, what makes her so amazing, is not just that she's a successful investor, because she's not the first successful female investor. Mm-hmm. It's that she's beating the guys at the game that guys are supposed to play best, which is being extremely aggressive and going after the biggest returns possible. Like that's her game, and she plays it unapologetically. That's what makes her so fascinating, is that she's playing a game that historically has been like pure bravado, like just dudes being like, I'm going to do 1,000% returns. Like women generally on Wall Street don't speak that way. And she doesn't even speak that way either, but she's literally doing it.
Yeah.
So my hat is off to her. Ben and I were talking about her today, about ARK. And one of the things that I respect about what they're doing is they're telling you, we're taking big risk for big return, and we're investing purely in innovation, and we're not hedging that bet at all. It is what we say it is. Yeah. And I find that to be admirable. It'll hurt when that segment of the market comes crashing down, but at least they're telling you what they're doing.
Is she the new Peter Lynch or the new Buffett?
I think new Peter Lynch sounds, just because it's a fund, not a company.
Yeah.
And I feel like she, as much as attention as they get, I feel like she's almost underappreciated. Like in terms of being a rock star, like there hasn't been a star fund manager in a long, long time. And I feel like
stocks, bonds, like Gunlock and
which is pretty, boring. I mean, they're index funds. It seems like Vanguard killed the star fund manager. The fact that she's been able to do it, I feel like she almost doesn't get enough respect for what she's done.
Yeah, I think I wouldn't really say she's either one. I say she's the first Cathie Woods, and I think that she's a trailblazer for women. And her style is just, is something that is going to be modeled after. I think people are going to model themselves after her. So like it's like asking like LeBron, is he the next Magic or Jordan? He's LeBron. It's kind of difficult to put him in either one because he's a hybrid. You can say
I like that take.
Oh, so that would be my take on her.
Well played.
Yeah, she's got a. I mean, like when we listen to music, it's like, yo, who has their pulse on what's coming, on what's hot, and I feel like she's had her pulse on it. And like if you look at the performance, look at in anything in that fund over the past 5 years, the returns are ridiculous.
Yeah,
she says that about that keeping the pulse. She says that that's like an advantage for her firm, which is that their compliance department is not stopping them from being out there talking to the public and like interacting with people that work at companies, and they're on Twitter and they're analysts or like attending stuff. And like a lot of asset managers traditionally, they're so afraid to mix it up and talk to people that they miss a lot of fine detail that she's picking up. So she's like really leaning into that idea of being on the pulse. So I think it's really good.
Me and Ben were kicking back when we saw that she invested in DraftKings. I'm sure we were like, yes.
She's got the golden touch.
She's watching what Ben's doing.
Ben was like, wait, he's putting his lineup in as it's happening. Like, oh, yeah.
Ben, it seemed like you've gotten a little bit more aggressive the last couple of months, and you're not as conservative as you used to be. So, which makes me happy. What would you have someone in their 50s who's just getting started? What would you have them start having the lens of, you want safety, but you still want some gains? And Lisa, thank you for the question.
All right. So I wrote a chapter about this. I'm going to get kind of boring like Michael. If you're starting out late in your planning for retirement or saving or investing, like the biggest thing you can do is just save money. So I ran the numbers on this. Let's say you think you're going to knock out of the park, and let's say the market does 6% over the long term, and you think you can do 12. Now I ran the numbers on this. You do better if you like double your savings rate versus doubling your investment return. If you have like 10, 20 years to start saving, as if you're doing it really late, that sounds really boring because you want to knock it out of the park. And I think people that late in the game that need to play catch up think that that's what they need to do. Unfortunately, because you don't have as much time to compound at that point, saving is way more important than investing. So like putting money aside first, that's the big thing you can do at that age.
The other thing with being in your 50s and even 40s is sequence of returns risk, which is a whole different topic. So I won't go too in depth on that. But we cite these numbers like the S&P is doing 14% annually over the last 10 years, and that's amazing. And that's something that's possible for the next 10 years. I don't picture it, but it could happen. But sequence of returns risk is you compound at this really high rate in stocks, right? And then at the last minute, when you're about to start drawing down for retirement, that's when there's the market crash. And you have no way you can't control that. So you could see in 08 or the lows in early 09, the S&P was down 57%, wiped out like 12 years of returns. Like think about that sequence of returns risk. Imagine 2008 was the year you first started drawing money down from your portfolio. You'd be terrified. You're like, wait, I compounded at a good rate all this time, and now it crashes. Yeah. So that's one of the other. That's why it's worth spending as much time as all of us do, telling people when they're young to start now, because that's just one other element to that.
Well, how do you mitigate that if it happens? Go ahead, Mike.
I was just going to say, at the lows in 2009, you were back to 1996 levels. Imagine that you were retiring then. I mean,
sick.
Just devastating.
That's tough.
I mean, it's pretty much diversification. You ask, like, what do you do? It's you have to diversify so you don't sell your stocks when they're down like that. And because everyone is jumping into individual names now, a lot of people don't realize if the market's down 50, a lot of your stocks are going to be down 75.
Probably. Yeah.
And again, that's an extreme example. But if the market's down 20, your stocks could be down 30 or 40. So you have to get to a point where you're never in the position to be a forced seller of stocks when you need to actually spend the money.
Yeah, because one of the things with that, I mean, the flip side to that is like the next year it was up like 57%, then it was up 48%. The market recovered in 18 months to where it was. So if you had cash on hand, or if you had money in even if you pulled money from a life insurance policy, if you were able to pull money from other places other than your retirement account, if you waited 18 months to 2 years, you would have been back to where you were.
Never waste.
Yeah.
So, what ratio would you have them at if they're, let's say, a year away from retirement? Would you have them do a 30-70 and 30 equity, 70% bonds? Like, how would you offset that if they were going to potentially hit like that disaster point?
The problem, this is my personal opinion with this. The problem with that is that, yeah, you could say 30% bond, 30% equities, 70% bonds, but getting to retirement is only half the battle. Like most people actually die climbing Mount Everest on the way down. They don't die because they don't have a plan to get down.
Mm-hmm.
Getting to the top of the mountain is only half the battle. So if you're 65 years old, you might live another 25 years. So it's kind of 25 years is a long way to just be extremely conservative and just bonds, because now you've accumulated money, but your money still has to grow because of inflation. So I think you still have to have some equities, because just getting to retirement is only half the battle. Like you're not just going to take the whole thing out in 1 year. And like I said, with the rise of inflation, you're not working anymore. A lot of other things, health insurance costs, things of that nature. You still need your money to grow. So
It's so important. The actuarial tables back you up. Like if you make it to 65, you have a 1 in 4 shot of making it to 95. And for the people who are investors, they tend to be like among the wealthiest people. They live even longer.
Yeah.
And you know, our parents and let's say our grandparents' generation, they didn't have to worry about this. You retire at 65, you have a couple of years left, like statistically, right? Mm-hmm. We have people that think they're going to retire at 65 and then they're going to live another 30 years and they're going to do that sitting in bonds, earning 1%. Where the fuck is your grocery money going to come from? You're going to be a burden to your kids. So one of the toughest tasks for financial advisors right now is to convince people in certain situations that they have to take risk more than they ever thought they would have to at an older age, and they have to accept more volatility as just part of, listen, you don't have that many options these days.
For those that want to get into the business and want to be fund managers, how important is client alpha? I know you touched on it briefly before, but could you three dive in about how selection of clients matters? And how big of a benefit has been to you on how you selected the clients that you choose to work with?
Mike, you want to jump on that?
Yeah, I think we're lucky because we put out a ton of content. So our client base is self-selecting. They already have a very good idea of how we think about the world. Whereas most advisors or people that work at a wirehouse, they don't really have, not to sound like a diva, but they don't have the luxury of getting to choose to who they work with. They will sell whatever they have to whoever wants to talk to them because they have to put food on the table. And they don't have people that are knocking on their doors saying, I like what you guys believe in. So I think it's incredibly important. It's a luxury that we have because imagine having a book of clients that just sort of came together. You said yes to some people that really weren't great fits. And then March 2020 comes along. And you're spending 12 hours a day on the phone with people that probably weren't good fits in the first place. I just think that becomes a real headache. So we're very lucky that the people that come to us already have a good understanding of what we believe.
It's one of the biggest advantages that Warren Buffett had, which is that he had no clients. Mm-hmm. All of the money he was investing was people making their insurance payments. They had no fucking say in any of that. It was just like, I pay my car insurance to Geico. Buffett's investing the money, but it's none of my business. So, and he had a partnership with investors prior to Berkshire Hathaway. And I don't think he could have done what he did because he had the ultimate client alpha situation. No clients, nobody to answer to for big drawdowns or concentrated positions or excess patience holding stocks 20, 30 years. Like nobody could really do that if they have clients to answer to. So that's such an important question. If you're going to be in this business, try to set expectations up front to the best of your ability so that you can have some semblance of client cooperation when shit gets sideways and you don't have to spend your whole day apologizing for stock prices.
Yeah. And lastly, is the Russell 2000 outperformance macro driven or is it luck in how well they've been performing like the last 16 to 18 months?
What do you guys think?
This is a great question. I saw this question and I flagged this as one that was really good because typically small stocks lead coming out of a recession, which is exactly what we're seeing. And so the question was, Is that happening because it tends to happen, or is it because of the GameStops of the world and all the Robinhood meme stocks that are in the Russell 2000? So I think it's probably a little bit of both.
I saw a stat today. 1/3 of the Russell 2000 this year, so 6 weeks into the year, are up 20% or more. So
That is insane. I told you guys go through the Russell 2000 for a reason in December.
This whole year is just built different.
It's funny because people kind of gave up on the small stocks, right? Because those huge tech stocks were doing so well for so long. Large cap killed it, and I'm just I think it could just be mean reversion. You can look at the economy and the macro stuff, but small caps underperform for a very long time, and part of it is risk appetite too. Where when people start going out on the risk curve, they're like, well, Facebook and Apple and Amazon, I've already done well with those. What else is there? Now I'm going to move down the pipeline a little bit. And I think that's kind of what happens as you get a little further along.
All right. I think that's a good place to stop for tonight. We're going to do this again tomorrow night, guys, right?
Every night.
Every night.
Screw all the other obligations. And sorry, Mike, you're not going to bed early.
So did everyone have fun? If you had
a
fun
blast.
out there,
Awesome.
All right. So we had a blast. This is one of the best conversations I've had in a long time. Just like speaking personally, this is a lot of fun, and we appreciate you guys coming and taking over the channel and bringing all your people with you, because the comments are hilarious. The comments are great.
You guys are funny.
Love the enthusiasm. It's just this has been a blast. And
I have to do it. One last question.
God,
what's the one piece of advice you wish you would have gotten when you were 25? And no fluff advice.
You go
regarding
first.
Investing.
You go first.
Put every dollar that I have into the market and hold it for 20. And funny part is, like, one of my friends, kudos to Art, he was working at JP Morgan in 2008, and he told me everything to buy, and I didn't do it. It was the biggest mistake of my life.
I'll piggyback on that. I don't really think that was a mistake, because my advice to my younger self would be, don't listen to anybody. Nobody knows what you're going through. And the only way to learn anything in life is to go through it, figure out what works for you. Everybody has different styles, different personalities. And so just do your thing and learn and try and fail and get up again and fail again and figure out your own way.
And that's the hardest thing as a young person, is to tell yourself, don't pay attention to how other people are managing their money or what they're buying and selling. It's even harder now because people are bragging so much. So back then when I was coming up, I didn't have Instagram to watch and look at people that were bragging about their life or their stock gains or whatever it is. So I think that's even harder than it is for young people than ever right now, is just avoiding what other people are doing and just worrying about yourself.
Yeah,
I think for me, it's carbs.
Me too.
Chill with the fucking carbs, JB. I wish somebody would have broken that shit down for me. I didn't have a nutritionist and none of that. I would work out and then go out for Italian food. I didn't know anything. I still don't know anything.
We're in the same tribe. We got to get on it.
No doubt. We will. 2022. I'm all the way there.
The biggest advice somebody would have gave me is to buy Bitcoin when it was 50 cents.
Oh man. Were you 20? Were you 25 at the time though? I don't know.
I wouldn't be here. My leisure would have been earned.
We would have earned our leisure. I'll say the best advice is block out the noise and stick to the script. Just stick to the script. It kind of like what Michael was saying. It was like, listen, if you've done the right homework, if you've done your own research, trust it. Just trust it. Don't just block out the noise, stick to your script, create your plan. But a lot of times people don't have a plan. They go off hearsay, they go off speculation. So create your plan and stick to your script.
I love you guys. Huge fan of you guys. I love the show. Thank you for having us on.
Thank you.
Of course, my brothers at EYL, Rashad, Troy, I appreciate you so much.
Always.
Red Panda. Boop, 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 boop.
Duncan, cue the music. I love you guys so much.
Thank you, Ian.
Greatly appreciate it. We had a ball.
This was fun, man.
Yeah, thank you.
Thanks, guys.
Thank you, guys. All right. Thanks to everybody.
All right.